so interest rate decision from the Reserve Bank next Tuesday. Not expecting any change from the cash rate to remain unchanged at 3% and the easing bias to be retained. If we have a look at what the Reserve Bank did at their February meeting, they've basically said that the inflationary environment is benign enough that if they wanted to ease monetary policy further that they could. But given that there's been monetary policy easing through 2012, that they prefer to take a wait-and-see sort of approach with economic data coming up to see how that prints before deciding whether any further monetary policy easing is required. So if we have a look at the data that's been released since the February meeting, and it certainly hasn't been weak enough to warrant any further easing from the Reserve Bank. The unemployment rate's held steady, it's at 5.4%. The components within the data a little bit weaker. Full-time employment did come off, but certainly not weak enough to warrant monetary policy easing at this point. Late in the month we did also have the CapEx data. This was quite key. If we had looked back to the December decision, it was the reason basically that the Reserve Bank eased at that time. Forward-looking estimates from the data released in late February certainly not weak enough. So with that in mind, the Reserve Bank doesn't need to do anything because the mining boom, even though it peaks, it doesn't mean that it's falling off a cliff anytime shortly. It's more plateauing. So certainly nothing from that data that would warrant any further policy easing as well. We had the consumer confidence survey data that's come out, and that actually showed a noticeable spike. It increased around just under 8%. We're starting to see the interest rate sectors of the economy starting to pick up a little bit as well, which is what the Reserve Bank's been looking for. So housing market's definitely starting to show signs of an upswing. Auction clearance rates and a few other things are performing quite well recently. So those sort of factors that the Reserve Bank would be looking to actually pick up have been starting to occur. So certainly warrants a more wait-and-see approach from them at the moment. If we have a look at the offshore environment, there's been nothing there that really warrants any cause for concern. We have had PMI data out of China that was a little bit weaker than expected during the month, but some of that can also be assigned to potentially seasonal effects from the Chinese New Year. Over to the US, we do have budget cuts coming up as part of the sequester that's required from the 1st of March. That totals around $85 billion and may detract around 0.5% from GDP in the US. So that will weigh on growth there. We've also had the tax increases earlier this year that are providing headwinds to the US economy. That said, the housing market over there is showing signs of picking up and can add to growth going forward. Over to Europe, probably the biggest cause for concern there at the moment is just the outcome of the Italian elections. Italian sovereign bond market, they've got the third most issuance in the developed market, so having a stalemate in the Italian politics at the moment, certainly not an enviable situation. Growth out of Europe, still particularly weak. Fourth quarter contracted 0.6%, and it's highly likely the first quarter this year as well will have a negative number about it. But all in all, there's certainly been nothing to suggest that the Reserve Bank needs to do anything at this point in time. We think they're on wait and hold, and it's probably likely that we may see something from them potentially around the middle of this year. But at this stage, cash rate's unchanged at 3%.